Good morning. Multifamily underwriting secrets that every investor needs to know. And if you've ever had a multifamily deal fall apart later in the process, chances are it wasn't the property, but it was the underwriting itself. And here's the reality: deals don't get approval based on what you think they're worth, they get approved based on how lenders underwrite the risk in that particular project. And as a mortgage broker working with multifamily investors across Houston and the nation, I can tell you this: structure beats rate every time. And let's break down the underwriting secrets that separate approved deals from the dead ones. So, first rule: DSCR is the gatekeeper, and not your pro forma is the point. Most investors focus on projected rents and the upside, but lenders don't. They focus on the debt service coverage ratio, or DSCR, and that's based on the actual in place rents and not future projected rents. Adjusted expenses, which are often higher than disclosed in a pro forma, but also stress tested debt payments. And a deal you think is a 1.25 DSCR can easily become a 1.1 after lender adjustments, or worse, below 1.0, which is an automatic decline for most folks. And the pro tip there is always underwrite your deal more conservatively than the lender would. Two, expenses are where deals quietly die, and lenders will adjust. Property taxes based off of the future purchase price and not the current value. Insurance, especially in Texas and in the coastal markets, there's a huge swing factor there, but also repairs and maintenance reserves and management fees, even if it's self managed. And this is where most deals can take a 10 to 20% haircut of the NOI. And the takeaway there is, if your deal only works on tight numbers, does it really work? Three, loan structure matters more than the rate. And most borrowers focus on getting the lowest rate, and as we should. But professionals know that there's other areas you need to focus on. And that could be an interest only period, or an amortization schedule that's longer, or flexible prepayment penalties for your loan term exit timelining. So, an example there: a slightly higher rate with an interest only period could improve the debt service coverage ratio and cash flow in the early years, and a lower rate with a heavy amortization could kill your deal right from the get go. The point is, the wrong structure can cost you more than a higher rate ever will. Four, exit cap rate can make or break your deal. And lenders and smart investors will underwrite their exits up front, and they don't assume that cap rates stay the same. And they don't assume that markets are going to improve. They assume that cap rates are going to expand. So, an example: say you buy a building at a 6% cap rate, but underwrite your exit at a 6.5 to 7%. That small shift can destroy projected profits, but also kill refinance eligibility. But it's good to have conservative numbers going in as well. Five, reserves and liquidity are non negotiable, and even strong deals get declined because of weak borrower groups. And lenders want to see post close liquidity. So, operating reserves often 6 to 12 months, and a net worth equal to or greater than the loan amount, which is a common guideline, especially in the CMBS space. Cash flow strong is not enough these days. Six, lenders underwrite reality and not a vision. And value add stories are great, but what lenders care about is what exists today and not what could exist tomorrow. So if your deal relies on rent increases, renovations, and lease up assumptions, you can expect pushback unless you have strong experience operating a similar business plan, heavy capital reserves, and a clear execution plan. The trick is preparing it properly. The real secret is structure your deal like a lender. And the best investors think like lenders before submitting a deal. And they could ask, what would kill this deal from an underwriting perspective? And what are the weak points? What are the strong points? And how can I de risk this project up front? And that's how deals get approved faster and close smoother. So, the final thought for today is that multifamily underwriting isn't complicated, but it is also unforgiving. And the investors who win are not the one chasing the deals. They're the ones structuring the deals that lenders can't approve and can't get funded. So if you're buying, refinancing, or repositioning multifamily assets, the difference between approval and denial is often just a few underwriting decisions. So work with a broker who understands both sides of the coin. And at Medallion Funds, we don't just submit deals, we structure them to win. And if you want a faster approval, a better execution, access to 600 plus lenders, let's talk strategy before you submit your next deal. And that, my friends, is it for the day. Please visit my website, billrapponline.com, to figure out how to get a hold of me. Please reach on out. I'd love to have a conversation with you. Take care.